Welcome everyone, I hope you're fine and doing well today. In this video I'm going to share you my favorite stocks that are not only undervalued but also paying huge dividends. Spare some free time and listen carefully, I believe this information will be valuable to you. The first stock for today will be Rowe Price with the ticker Rowe. This is an American holding company managing a group of more than 150 funds. At the moment, the company is actively developing towards ETF. Since 2021, the company has increased their number from 4 to 10. Many of you know what a promising direction for investment this is and how much money has been invested there in recent years. Now let's move on to the dynamics of the company's earnings. Net profit is growing and the growth rate is high, which means the company is actively developing. We will also see revenue decline in 2022 due to falling stock markets and rising key rates, but we will talk about this problem a little later. The PE indicator that measures the market value of a share in comparison to the profit generated by the company is 13.5, which cannot but please us as an investors. This company also pays dividends and they make up a very good return of 4.1% on capital invested. The company is a dividend aristocrat and has been rising dividends for 36 consecutive years, with an average annual dividend growth of 16% over the past 5 years. The company is also purchasing its free float, which increases our stake as investors in the company. The company's assets under management are $1.3 trillion, but back in 2021, when there was a rise in stock markets and low key rates, the company managed capital of almost $1.7 trillion. Of course, we as investors do not really like it, but it is worth noting that this outflow of money occurred from all assets and capital management companies in general. That is, for example, in the largest company in this industry, BlackRock, the drop from peak values was about 70%. In our company, a little more, namely about 21%. But at the same time, according to the forecast of analysts, as soon as the key rate in the US decreases, the money will again go to the market, including to our management company, because the yield on US bonds will decrease and the money will return back to the stock market. This is why you should pay close attention to stocks that are currently have problems in their businesses. After all, the company's shares are currently trading about 45% cheaper than in 2021. But when the stock market normalizes, you will no longer be allowed to buy this asset so cheaply. In general, despite all the business problem, I still consider the company attractive to acquire, given its growth prospects and large, stable dividends. And the second stock for today will be Intel. Intel is the largest developer and manufacturer of processors in the world. But contrary to opinion of many, Intel has long been not only a manufacturer of processors. Now the company is actively engaged in a huge number of promising areas, such as building data centers, autonomous driving, and also Intel is now building factories for the production of semiconductors. This will be contract manufacturing, that is, products will be produced for other companies. In fact, this is what Taiwan Semiconductor does. But since these plants are now being built, the company has a lot of expenses. But in subsequent years, after all the plants are built, the company's revenue and net profit will grow rapidly. Until that happens, Intel is unlikely to show outstanding financial performance. The company has been trading at insanely cheap prices for the last year, which allows us to gain an excellent position in this stock for the long term. I repeat once again, this is not an idea for the short term, but for the long term, starting from a period of about 3 to 4 years. Let's look at the financial performance of the company. It increases both revenue and net profit. Of course, the growth rate is not the best, but still not bad. If the company manages to release its plans for the development of technology in the field of semiconductors, then we will see pretty good growth in all respects. Speaking about the company's balance sheet, here we can see such a situation that the company's net share capital is growing, while the business's debt load is low. Well, now we move on to the most interesting in our business, which is of course value indicators. PE ratio is 9, PEG is less than 1, PB is almost equal to 1. In general, according to all financial indicators and financial ratios, this business is very much underestimated, while the company does not forget to pay very generous dividends with a yield of 5% per annum. The company on average increases dividends by about 6% per year. Also, business does not forget to carry out buyback procedures, which increases our share as investors in the company. In general, a very interesting asset at current prices. But again, this is a long-term action. Do not expect big growth in the near future. Therefore, if you are ready to wait, this is a great share that will show itself in the future. And the last stock for today will be Leggett Platt with the ticker LEG. Founded in 1883, Leggett Platt is a 140-year-old company that had been able to survive all crises and also pay huge dividends to its investors. But more on that later. Almost 50% of the business's revenue comes from metals products, and the company also provides parts for cars and even aviation. These are springs, rods, wire, hydraulic cylinders, and other metal details. Let's move on to the financial performance of the company. If we look from 2009, we will see that the company's revenue and net profit have a clear upward trend. Over the past 12 years, revenue has more than doubled. And I want to emphasize that this is a real production, and for a real production that works and scales, these are very good indicators. If we look at a company's balance sheet, we can see that assets are growing much faster than liabilities, from which we get equity growth. The company also has a very good business margin, especially if we remember that this is a manufacturing company. The PE ratio is 13, and this is a very good indicator of both the market and the industry. And now we will move on to the company's dividends. Incidentally, the company has been increasing dividends annually for about 50 years in a row. The current dividend yield is 5.2% on capital invested. That's just a huge return for the US stock market. Dividends are grown by an average 4% per year and outpace the average US inflation of 2.25%. What is the result? Business is valued quite cheaply. At the same time, we see that the business is developing. Revenue is growing, net profit is growing, the company's net share capital is growing, and just huge dividends, which tells us the company is very much undervalued by the market. So for me personally, this is a very interesting asset to acquire. Friends, and I want to remind that I do not give any financial advice, but only share my thoughts and ideas. If you find something useful for yourself, then click the like button and subscribe to the channel. Thank you very much for watching, and until next time, see ya!